Okay, so welcome to this Corporate Governance Knowledge Lab, a series of online events organized by the BAFA Corporate Governance Special Interest Group. I'm Konstantinos Stathopoulos, I'm SIG's, the group's chair, and I'm thrilled to kick off this series with what promises to be a very informative event. The purpose, when we started debating about having this Knowledge Lab online series, was we wanted to have an initiative that brings together academics, practitioners, regulators, and policymakers to debate about current practices, as well as the future of corporate governance in this country and globally. Our guest for this inaugural event is Ms. Jessica Dahlstrom, Acting Head of Corporate Governance at the Financial Reporting Council. Jessica has extensive experience both in the public and private sectors as an economist and a governance expert. Prior to joining the FSC, she was Chief of Staff and Director of Corporate Affairs at Guy's and St. Thomas Hospital, where her role included providing advice and support to the Chief Executive, as well as overseeing changes to the corporate governance framework during a period of mergers and organizational change. To all participants, thank you so much for those of you who have already submitted your questions. You can still submit more questions as Jessica goes through her presentation. We will try to make sure that we cover as many questions as possible, but of course, given time limitations, that might not be easy to achieve. Jessica, the virtual floor is yours. As we agreed, 20 to 30 minutes for your presentation before we go into Q&A. Thank you.
Thank you very much, and thank you to BAFA and to Kostas for arranging this event, and for everybody for making time for it. I'm really pleased to be here today and tell you a little bit about the FRC and about the corporate governance and stewardship work that's going on for us at the moment. So just to begin, I'll give you just a little bit of background on the Financial Reporting Council in case anybody on the call is not familiar with us. So if we go to the next slide, the FRC is the regulator of auditors, actuaries and accountants, but we also set, as many of you will know, the UK Corporate Governance Code. We set the Stewardship Code, and recently we've also become responsible for the Weights Principles, which are corporate governance principles for large private companies. So these are roughly the areas that I'm going to be talking about today. But I do want to say at the outset that on the Stewardship Code particularly, we've just closed a consultation, as you may have seen, on changes to the Stewardship Code. And we're right in the middle at the moment as a team of analysing the responses that have come in. So I'm not able to say very much in terms of direction of travel, because we do need to wait and see and review what everybody said. But I will talk about the proposals as they were when we went into consultation on the Stewardship Code. So that's just a quick view. Moving on then to the next slide. Just a tiny bit of background on the Corporate Governance Code for those who are not fully familiar. So the UK Corporate Governance Code is followed by companies listed on the London Stock Exchange. Sorry, I'm getting some notes saying unstable network connection. Can I just double check with you, Kostas, that you can hear me fine?
Yes, absolutely. Yes. Yeah, there was a little bit of an interruption, but now we can hear you well.
Okay, yeah. Do shout if anything goes wrong, because I wouldn't want to speak for half an hour and not know whether you could hear me or not. So I'm going to assume that that's all fine. So just back to the UK Corporate Governance Code, so followed by companies listed on the London Stock Exchange. There's been a relatively recent change actually in the categories of companies that follow the code, because the FCA previously had two categories of companies listed, one being premium listed companies and the other category being standard listed. In the most recent revision to the listing rules, that distinction was essentially eradicated. So we now have a commercial companies category, and all those companies follow the code. Any company that was previously listed as standard has gone into a transition category with a view to potentially joining the commercial companies category in due course when they're ready for it. So potentially slightly more companies who will follow the code. The code also applies to closed-ended investment trusts. Bit of a niche point. There is another code which is published by the Association of Investment companies, which we endorse as the FRC, which trusts can funds can also follow. The most important feature of the code is its flexibility, really. So the principles that are contained within the code are very high level, very flexible, and we ask that companies apply those principles. But they are then supported by more detailed provisions, which are a bit more specific. And we ask that companies either comply with the provisions or explain the approach that they've taken to the provisions if they choose to do something different. And actually, we're really in some ways quite keen for companies to think very carefully about the provisions and to depart from them if that works better for their circumstances. So what we really like to see on the back of the code is reporting that's very company specific and meaningful for shareholders and for stakeholders rather than anything too boilerplate. So that's just a quick canter through of the code. Moving on then to the next slide, as I think many people probably be aware, we did revise the code last year. We ran a very long and thorough consultation on proposed revisions to the code and received a huge amount of feedback, which was brilliant because it just goes to show the level of engagement from all of our stakeholders in the UK and abroad in the code. And we really made changes, I think, on the back of that feedback, scaled some of our proposals back, adjusted others, and have ended up with what is now the 2024 code. And on this slide, I've just highlighted the main changes in the 2024 code when compared to 2018. I won't actually read them out to you because we're now going to go on to some slides that talk about these in more detail. So on the next slide, one of the main features of the new 2024 code is an increased emphasis on this comply or explain feature, which I mentioned earlier. And what we've done by way of a change to section 1 of the code is to emphasize the importance of meaningful explanations where companies choose to depart from the code. I have included on this slide just a little bit of background as to why we've done that and also trends in terms of code compliance. We found, particularly last year, as we were consulting on changes to the code, that there was quite a lot of noise around is it really comply or explain? Is it in fact comply or else? Are the expectations of investors, of proxy agencies, of others full compliance? And are companies really able to depart from the code? So putting extra sort of information in the code on the ability for companies to depart from the code and explain, we thought was an important thing to do. In terms of trends, interestingly, we did see, I'll come on to talk about our annual review of corporate governance reporting, but we did see last year slightly fewer companies depart from the code, which in some ways, you know, we quite sort of pleased that more companies are brave enough to depart. But what happened there last year is we have a very specific provision in the code around aligning pensions, executive director pensions, with the workforce, which was a great source of departures from the code in previous years because companies were not able to update their contracts. Many companies were able to do that last year, so actually we ended up with more code compliance last year compared to the year before. But generally, the trend has been in previous years increased departures. So that's, I think that's good because it shows how flexible the code is. Moving on to the next area of change. This is also in section 1 of the code, and this is around outcomes-based reporting. So we wanted outcomes-based reporting has been a priority for us for a while, and what we mean when we say that is we really want annual reports not to include sort of lengthy policies, procedures. This is, you know, on diversity and inclusion. These are all the policies we have. What we really like to see is this is what's happened this year. This is what we've done, and this is the impact of what we've done. So that's what we mean when we say outcomes-based reporting. And for the first time now in the 2024 code, we've included a reference to outcomes-based reporting in the code. So that's really important to us. in our annual review. Again, we look at this, we see some good reporting, particularly on stakeholder engagement. Companies seem to find it easier to say, well, this is, we've engaged with the following stakeholders and done, a number of actions on the back of that. There are other areas where there's still quite a lot of room for improvement. The third area of change then, which is the one really that many people talk the most about, is around risk management and internal controls. So I've got a couple of slides on this, but just in a nutshell, you'll hear me say provision 29 a lot because that's the main provision that's changed, which now asks companies, as well as reviewing the effectiveness of their risk management and internal controls procedures, to include a declaration in their annual report that they have done that and what the outcome of the review was. So that's attracted a lot of attention. I think it's important to say that the aim of the new provision really is to elevate risk management and internal controls to gain more attention at board level, and to really, I guess, stimulate a discussion on risk and proportionate risk taking. So we're not saying with this provision companies must take less risk, because that's not at all what this is about. It's about boards understanding their risks, discussing their risk appetite, and then understanding how their material controls bring each risk into line with what sort of risk appetite they're comfortable with. So just on the next slide, just to bust a couple of myths, we like to put this slide up because what it shows is that much of provision 29 isn't new. So the 2018 code had an equivalent of provision 29, which also incidentally referred to financial controls, operational controls, and compliance controls, to all material controls. So, sometimes people say, oh gosh, you've really extended it now, haven't you? But all material controls were already referred to in the previous code. I think the difference, which is quite clear to see here in red, is this declaration. So we're asking for companies to talk about, to describe the review of effectiveness that has taken place, and then to make a declaration that the material controls are effective, or at the date of the balance sheet, if there was a material control that wasn't operating effectively, what's the action plan for fixing it? So that's it really. Generated a lot of discussion, and it still does. I mean, it still does, and we're really pleased in some ways that it does now generate a lot of sort of work for us, because we are talking at the moment either in larger groups or bilaterally with companies about the work that they're doing to prepare for provision 29. And whilst we can't in those bilateral conversations sign things off, we can talk to companies about the intention behind the provision, point towards our guidance, etc. So that's just a quick overview of the changes to provision 29. And this slide just finally on provision 29, what does good reporting look like? It seems pretty obvious. I don't expect you to speed read all of this, but I mean, what we're really hoping for companies to do is to confirm, sometimes they don't even do that at the moment, confirm that a review of effectiveness has taken place. Describe, not in pages and pages, but briefly, how the review has been carried out, who's done it, how has the board been involved, etc. And then finally, include the outcome of the review, i.e. the material controls were effective, or they were all effective apart from this one, and we're doing the following about that. So again, it is quite surprising at the moment, even given that we do already have a provision on this, that sometimes companies might say, the risk management and internal controls are reviewed regularly, but it doesn't say a review has taken place, this was the outcome. So those are the sorts of things that we are looking for there. Moving on then to the final it's not so much a change to the code as an important change that we've made to the guidance. I don't know if many people will be familiar with this, but the FRC previously had, I think it was 4 separate guidance documents in PDF form that were issued in support of the code that were becoming out of date, certainly obviously were out of date in light of the changes to the code. And we're not, I don't think, especially well used. So we've updated our guidance now to be interactive online. You can be in the corporate governance code and click on a link, and it takes you to the relevant bit of the guidance. We can keep it up to date if there's a new publication, perhaps that's relevant to a certain topic. We can include it, etc. So we have updated the guidance and hopefully made it more user friendly. Those are the changes to the code, I think. Yep. Just very quickly, timing wise. So the new code is now live, as in it is sort of applicable for financial years starting on or after the 1st of January 2025. That does mean that the annual reports that are coming in, being published at the moment and will be for the coming months, will still be annual reports that have been produced under the old code, because the applicability has only just started in January. So we expect to see our first annual reports against the new code really from 2026 onwards, unless, of course, there may be some early adopters, which we'll be looking for in our annual review this year. It's worth saying that provision 29, which I spent quite a lot of time on, we've given companies more time to implement that, because the feedback in the consultation was that for some, this could be quite a bit of work. So that provision doesn't commence until the 1st of January 2026, which means the reporting on that provision, we won't see that until 2027, again, unless there's some early adoption. So those are the timelines. Moving on then to our annual review. I've referenced it a couple of times, but just to tell you a little bit more about it. So another big part of our work in the corporate governance team at the FRC every year is to look at a sample of annual reports. So we always randomly choose a sample of 100 companies and review their annual reports. We do make sure the sample includes companies of different sizes, maturity, different sectors as well. And what we do is we, before we sort of go into that exercise, we as a team agree certain questions for each section of the code, really, that we want to test in terms of how are companies reporting in this area, on this provision, etc. And then it culminates, we do all of that review. It takes quite a long time to gather all the evidence, but that culminates then in a publication, normally around October, November time, where we talk about trends in corporate governance reporting. And very importantly, we highlight examples of good reporting. And we hope, and we tend to receive feedback that companies are finding that quite useful, that they're able to read that publication and see some examples of a company that might have reported against a particular part of the code really well. What we don't do is name or shame. We never say this was an example of poor reporting, or this company hasn't done very well. But we might say, actually, this particular area of the code is not well reported against, and we'd like to see more focus on that. So that's just what the annual review is. My next few slides are just about what we found in last year's annual review. I've already talked a little bit about the fact that fewer companies last year chose to depart from the code, and that was because of that sort of slightly technical pension provision. But we took the opportunity of the annual review again to remind companies that they can depart from the code. And in fact, we often, we would potentially consider a departure from the code with a meaningful explanation to be better governance than sort of blind box ticking type compliance. So we'll be interested to see this year as to what the trend is in terms of departures. I've also already talked a little bit about outcomes reporting, and that it's a really mixed sort of set of findings, really, in terms of outcomes reporting. Pretty good on stakeholder engagement, less so, for example, on culture, which is a difficult area. But culture is, for some companies, seems to be an area where they do become tempted to make some fairly declaratory statements without saying, well, actually, these are the behaviors that we're encouraging in the company, and as a result, the following, or the reasons why, etc. So we're hoping really for more outcomes-based reporting on culture. these are some areas that we have seen really good reporting in. So workforce and stakeholder engagement. The chart there, which is, at least on my screen, absolutely tiny, so apologies for that. But the purpose of the chart really is to show that actually companies do appear to consider a wide range of stakeholders when it comes to their engagement, and therefore their reporting in their annual reports. And they talk about engaging with governments, regulators, the media, but also other non-governmental organisations, etc. So there's quite a lot of interesting reporting we find on stakeholder engagement. The other area where last year we felt reporting was strong was overboarding, which is the practice, for those who might not be aware of, directors sitting on a number of boards and therefore perhaps not being able to dedicate enough time to each board position. We considered actually in the consultation on the 2024 code adding some more content on overboarding and perhaps even limiting the number of board positions people should hold. But we decided against it based on consultation feedback. And actually, we feel, having looked at this area specifically in the annual review, that was the right decision, because it seems very well reported on. Companies appear to be on top of how many other boards their directors are on, and where that number is reasonably high, or perhaps a person has a committee chairing role as well. There is often in the annual report a discussion of how they manage all of that. So good reporting on that. Moving on, we didn't, no surprise really, but we didn't see any early adoption, of course, of Provision 29, and we expect we might not see any of that this year either, but we will certainly look out for good reporting on the preparations that companies are making. And it might be interesting just to point out that we always look at cyber and information technology, and 89% of companies in their risk reporting include cybersecurity as a principal risk. And we also looked this year, in fact, we've looked for a couple of years at reporting on AI as well. And 73% of companies discuss something to do with AI. So that was our review of risk reporting. Looking ahead, we've just started, because the first annual reports are now out, on our 2025 review. We will take, as we do every year, a sort of slightly different approach, because if we were asking the same questions every year, we'd probably end up producing very similar reports. So this year, we will obviously look at early adoption in any area of the 2024 code. We plan to look a little bit differently at remuneration reporting, because we found, everybody tells us, and it's certainly the case, that the REM reports are very lengthy. Much of the content is driven not by the code, it's important to say, but by regulations. We'd like to have a look this year to see if we can produce some more interesting statistics, some visual representations of how people are reporting on remuneration, and maybe contribute to the debate on how we can make that less onerous for companies. We will look again at cyber and AI. I should actually have said on the previous slide, even though AI is mentioned in the majority of annual reports, companies don't talk to us, don't talk in their annual reports about whether or not they've used AI in the preparation of their report. So that's quite, we're not able really to say anything about that, because we don't know, and that's an area of interest to us potentially in the future. And also this year, for the first time in a while, we will ask some particular questions as we go through each annual report on how companies report on their, whether they have internal audit, how they interact with their internal auditors, and how they assess the quality of the internal audit that they receive. So we have some questions on that as well this year. Weights, yep. So I don't know if everybody's familiar with the weights principles. Large private companies are required by law to disclose corporate governance arrangements, and the weights principles really exist to help those companies with that. So they were devised by a weights coalition, and they're fairly high level. They are apply and explain, a bit like the principles of the code which also need to be applied. They're so high level that we think companies should be able to apply them and explain. And then on the next slide, I just wanted to mention that having been originally devised by the Weights Coalition group, the Weights principles have now moved to be overseen by the FRC. So, to the extent that, in future people wanted to look at updating them, that would now go through FRC governance, etc. And we will do any work associated with the Weights principles going forward, obviously working closely still with those individual members of the Weights Coalition that want to remain involved. As a first piece of work, what we're considering at the moment is just to look at those Weights principles that are less well reported against, which we know from previous research there are some that are not so well reported against, and perhaps seeing if we can do a sort of relatively light touch short publication that sets out some good practice, some good examples for reporting against those less well reported against principles for companies to look at. And we will run some roundtables as well to get companies' input on weights. So that's the weights principles. I think I've now got to the stewardship code. Very quickly, again, if you don't know what it is, the stewardship code exists for those who either own or manage assets, and also for those who provide services to asset owners or to asset managers, to really set high stewardship standards for investors. And the stewardship code is also apply and explain, again, principles that are sufficiently high level for that to be possible. And as I've mentioned, we've recently consulted on some changes. I can't go into too much detail, but I will in the next few slides just give you a short overview of the consultation. So timing wise, the consultation closed in mid-February. We're now in March. We're still mid-review of all the responses that we received. And at some point this year, I really can't sort of pin it down to any more specific point in time, we will publish a new stewardship code and have as the proposed implementation for that 2026. So the key areas that we covered in the consultation were, well, they're summarized here, but I've also got a slide on each, I think. So moving on to the next slide is first of all a revised definition of stewardship. You have to look quite closely to sort of see the difference, but essentially where previously the phrase used was leading to sustainable benefits for the economy, the environment, and society, the phrase used now is to create long-term sustainable value for clients and beneficiaries, but with an important accompanying text around sustainable long-term returns which deliver benefits for the economy, the environment, and society. So it's a shift, and the reason for the shift really is to give signatories to the stewardship code the more flexibility in terms of determining what they want to achieve for themselves and for their clients. So it's an intention to be more flexible. We've received a lot of feedback, and as I say, we will land on something which will be published later this year. Another change is just a streamlining of the principles in the stewardship code. So there are some principles currently in the code which ask those who are signatories to the stewardship code to report material which is relatively sort of stable in the long term. So what's your organization like, your beliefs, your governance, etc. And then there are other principles that are more ad hoc and change year on year. What have you done this year, etc. So what we are proposing is a streamlining by which signatories don't need to repeat the same information every year, to the extent that some of reporting against some of these principles is constant, that can remain the same. So hopefully reducing the workload a little bit. Moving on to the next slide, like with the corporate governance code, this didn't exist previously for the stewardship code, but I think there has been quite a lot of demand for it, is we plan to publish some guidance, some prompts, first of all, as to how to report, but then some more detailed guidance underneath that with examples, etc., just to give those who are either current signatories or those who might be considering becoming signatories to the stewardship code a little bit more just advice in terms of what approach to take, and that guidance will be is currently being developed. So that's the guidance. And then this area I think is quite interesting because there's a sort of crossover to corporate governance, I think. So we are also consulting on allowing cross-referencing from stewardship reports to material that sits elsewhere, perhaps on a signatory's website or in another place. Again, sort of with the aim of reducing duplication, shortening the reports, making life easier. A click-through link to other information is going to be, if we proceed with this proposal, is going to be allowed. And it's something I know has been talked about quite a lot in corporate governance spaces as well. Could we reduce the length of the annual report by allowing more content to be placed on the website and for there to be links, etc. And I think that some companies are doing that already. We do, careful thought obviously has to be given because there's different statuses in there of information that once it's in the annual report, auditors look at it, etc. So, but an interesting proposal, which again we're looking at the feedback now, and then just on the next slide. So yes, I'm really keen to just talk about this briefly. We do from time to time at the FRC do research into matters sort of interest in the corporate governance or stewardship space. And at the moment, we are working in partnership with an organization called Progress Together on a small research project, which is really their project, but we are contributing to it, which is around looking at the level of socioeconomic diversity in the at senior levels in large financial services firms, and are there initiatives in place to help people from lower socioeconomic backgrounds to really sort of, I suppose, climb that career level ladder within financial services and get into leadership positions. So that's really the purpose of this research. As I say, it's a Progress Together project. We are helping. We're very interested because obviously the code is in part about making sure the best and most talented people can lead companies. And we're very much hoping that when the report does come out, as well as being useful to the financial services sector, all companies who follow the code or even beyond can learn something from some of the initiatives that are being tried out by some of these firms. So that's the research project. My final slide is just a link to all of, many of the things I've talked about, and I'm sure will be shared after the meeting. But that's it. I think Costa's very happy to take any questions.
Thank you so much, Jessica. It's clearly many areas of engagement, and you keep yourselves busy. So I'm sure there are going to be many questions from the audience, primarily through, as I said, please type your questions on the chat. But we have already questions that were submitted during the RSVP. So I want to make sure that I'm fair to everybody. So I'm going to try to go as quickly as possible through all the questions. So let me just first ask, there is a lot of debate about whether we have, whether corporate governance and all the regulation that comes with corporate governance and the associated costs, whether it's about accountability, transparency, etc., are anti or pro-growth. So there's a lot of debate currently because the UK government wishes, to have a pro-growth agenda. So where do you see corporate governance regulation and the regulatory framework we currently have in the UK sits into that particular debate?
Yeah, I think the first thing to say, it's a really important debate. And I think at the FRC, we've had growth as part of our sort of duty and objectives for a very long time, but we're certainly very focused on it now. I think in the UK, we should really be proud of the corporate governance arrangements that we have, because they are considered to be of a very high standard and very flexible, and therefore conducive really to businesses kind of coming here, listing, growing, using the code in a way that works for them, and using that flexibility really to generate growth. And I think we mustn't be sort of shy about saying that high standards of corporate governance inspire investors or confidence, and therefore can be very, very conducive to growth. I think, of course, there are costs associated with compliance, and we must be very mindful, and we must be very mindful of the messages that we send, which is why when I was talking about our new provision on risk management and internal controls, I really wanted to emphasize that this is not a sort of an initiative to discourage companies from taking risk. This is really an attempt at asking boards to think about what risks they're comfortable with, and what controls they need in order to almost facilitate the risks that they need to take in order to grow this. So it's a debate. It's a very important debate. We are very much on the page of the code being there to support economic growth.
Yeah. You did mention something about sustainability in general, but I want to ask, do you think that the overall regulatory framework we have in the UK is fit for purpose as far as the ESG agenda is concerned? So there's this debate about whether it's, for instance, the Corporation Act, is very focused on director fiduciary duties towards shareholders as opposed to stakeholders. Do you see that there's any tension in this area?
I mean, again, an interesting question. I think an important sort of point to make here is that it's not necessarily a trade-off. It's that you're working either for the benefit of shareholders or anything that you might do for your other stakeholders is to the detriment of that. I think certainly a well-run company can achieve rewards, I suppose, for shareholders and for other stakeholders alike. And from my perspective, I mean, I think the code lands in a reasonably balanced position on this. I mean, we've got our principle A, which actually, we'll probably look a little bit this year in the annual review as to how companies report against principle A of the code, is all about a board promoting sustainable success and generating value for shareholders, but also contributing to the wider society. So we think the code sort of is set up to do that. But my main sense is not to sort of almost see it as a choice between one or the other, but try and see it as something that can be combined.
Absolutely, yeah. So there is a question from a participant about outside independent directors. So do you think they do make a difference in corporate governance? I believe the participant is rather skeptical because he says when companies are in trouble, the independent directors are not taking responsibility. So what are your thoughts on that?
I mean, I think it's really important around the board table to assemble different perspectives, isn't it? And I think we're all probably on the page that having diversity and having different perspectives around the board table will add value and will lead to better decision making. And I think as part of that, having that independent perspective, which is sufficiently divorced, I suppose, from the day-to-day running of the business and the decisions that management may want to take, it has got to be valuable. So we think that's an important part of the code. I'm very interested in the view of your participant that might not be the case, and I wonder, why they think that. But it seems to me that if you didn't have that, you could end up in a scenario where everybody was just agreeing with the direction of travel because everybody's so invested in the outcome of their own decisions that you'd lose some of that independent sort of value in the decision making.
Yeah, absolutely. Just maybe to build on that, because I remember we hosted some time ago an FRC event here in Manchester. And we had David Stiles, presenting, and it was a previous iteration of the corporate governance code. And we were chatting about the definition of director independence and whether it's restrictive enough or flexible enough to take into account social networks and potential, things that do not come directly into a box ticking like, oh, it's a family member, it's somebody who has worked, has business relationships with the firm. So again, do you think there is any scope on revisiting the definition of independence?
I mean, it does come up from time to time, and it has come up recently. And people do ask us about that, and I think it's good. It's a good topic to keep thinking about. I mean, there's also something around sort of, independent on appointment, and then how long can you still consider to be can you still be considered independent after you've joined, etc.? When do you stop being an independent director? So I think these are all really important discussions. And you're right, the world has kind of moved on, and people are connected in all sorts of ways now that they might not have been before. So it's a very interesting area. I almost would guess that any definition has some shortcomings, but
Yeah,
it's
absolutely.
worth keeping it under review, I think.
Yeah. So there's a question on Provision 29. Is Provision 29 likely to become the responsibility of a particular board committee?
So so we would say we would very much like it to be a responsibility of the board. The board is asked to make the declaration. Now, it is, of course, up to the board then to delegate some of the work and some of the thinking associated with Provision 29 to committees. And therefore other committees, including the audit committee, which I imagine where this question is leading, are likely to be involved. I mean, some companies obviously have risk committees as well, and you can see arguments that arguably there's a role for many committees in contributing to Provision 29. But it's really important to emphasize that the whole almost reason for being for this change to the code is to get the board's attention on risk management, internal control. So we would prefer it, I think, if companies didn't simply delegate everything, but kept their board very much involved in this.
Yeah. Another question is about the future of corporate governance. I appreciate it's very open-ended, but you did mention something about AI. It was more about how companies use AI to prepare their reports. There's a very specific question in the chat about how does the FSC expect the adoption of AI to impact both financial reporting and audit for small, medium, and large firms? So do you see that what's your initial reaction, and do you see differences in terms of firm size?
Yeah, it's a very live question, and I can't really, I don't think, talk too much about the audit side. What I do know is the FRC is is looking at this very closely and doing quite a lot of work on this at the moment, because I imagine there will be quite significant implications for audit. In terms of corporate governance, I think there will be a major impact, and in fact, AI may be already having quite a significant impact on how annual reports are being put together. That is, is not directly visible for us at the moment. So I can't say too much about that, only to say that we're very sort of aware of it. Mm-hmm. We've got, a group within the FRC really working across all of our functions, including corporate governance, audit, actuarial work, etc., looking at AI and how it impacts our work, how it impacts the reports that we receive, etc. But it's a kind of a watch this space place at the moment. And we did ask a question actually in our consultation on the 2024 code about whether our stakeholders would like to see something in the corporate governance code on AI, and the majority of responses that came back were along the lines of it's a bit too early to say what that should be. Right. But I think people did feel that it was very important that the FRC kept a close watch. So that's what we will do.
Excellent. So there are a couple of questions on international comparisons and how changes at the global level might affect the future of the UK Corporate Governance Code. So just to be more specific, there's a question about whether the FSC, what is the FSC's view on the current debate in the US about EDI, the changes in the Delaware law that are just now getting implemented, etc., and how that would affect the UK code. Is it something that you are considering? You think that things are moving towards a certain direction, in which case, the UK will have to respond?
So I think it's very important, clearly, given all the changes that are going on. Firstly, that the UK remains sort of competitive as an economy. But secondly, also that we don't, I suppose, throw out in a relatively knee-jerk reaction some of the fantastic sort of corporate governance standards that we have in the UK. And in my view, the code provides is sufficiently high level and provides enough flexibility really to work for companies, even in the context of changes in other countries, including the ones that are currently happening in the US. I mean, of course, in terms of Sarbanes-Oxley, etc., the regime in the US is still sort of, I would say, probably more onerous than what we've got here. So there's different sides to this debate, but the beauty of the code is it does stay at a sufficiently high level, I think, to give us that flexibility, really.
Excellent. So you mentioned in your presentations, you highlighted a particular research project you now collaborate and try to contribute to. So what obviously the predominance of the membership here, in this event is academics. We care a lot about engaging with regulators and particularly with the FRC. So what kind of opportunities do you foresee in the future for BAFA members to collaborate with the FSC? Are there, other than the current project on socioeconomic diversity and its impact, are there going to be future projects that you think you're going to be asking people to tender for?
Yeah, so I think there's sort of there's both sort of proactive research, I suppose. So there may well be areas in future that we, as the FRC, say actually we need to do something in this space. In which case we would obviously, if it's something that we can't resource ourselves, and we are a very small team in the corporate governance team in the FRC, we would go to tender for that. There isn't anything immediately on the horizon for that, but the other thing I would say is we're very interested always to hear from academic colleagues who are doing something in a space where we're also in, just to come and talk to us about what's being done, perhaps receive a presentation, start a discussion, etc. Those kinds of things are really helpful, because of course there's so much excellent work being done out there on corporate governance or in areas that are sort of tangentially related to it that interests us very much. So please do, I would say, get in touch if there's something that you think the FRC should be aware of, you'd like to come and talk to us about.
That's fantastic, because that was my next question. So you do, accept unsolicited, offers for exchange of ideas and things like that. So I guess there is a department, I know the research department that you have in the FRC. So is the advice then for BAFA members to talk directly with the research department of the FRC and try to bring to your attention specific projects or ideas, etc.?
Yes, I think that's the best place. And I think, I'm sure it's not really my area, but there are some hurdles or steps that we sometimes need to go through before we can, for example, make statements around having used research or endorsing it or anything like that. So, but I would say start the conversation, definitely. I think if people have the contacts of our research team, then please use those. But if not, I'm happy to Kostas perhaps share them through you afterwards.
Fantastic. Thank you so much. It's been great. I personally learned a lot. I hope, the other members here, other participants, also learned a lot. We ran out of time. So Jessica, thank you so much for sharing your thoughts. A big thank you to all the participants, of course. And please try to stay in touch, with the Corporate Governance Special Interest Group. You can follow us on LinkedIn. We have a dedicated page where you can see many of the activities that we plan on and events that we plan to organize over the year. So we do hope that you stay in touch, and we hope that you join us in the next event, which is going to take place soon. Thank you so much, Jessica. Thanks again. It was great.
You.
And see you soon. Thank you all.
Thank you.